The Malaysian ringgit keeps losing value, and people are asking why. Everyone feels it. Prices rise quietly. Imported goods cost more. Malaysians working overseas send money home, and families are happy about the exchange rate, but deep inside, everyone knows this is not a good sign for the long term. The ringgit is not falling because Malaysia is weak or unstable. It's falling because the world changed fast, and Malaysia is trying to adjust while the United States keeps tightening global money power, and investors keep shifting money to safer or higher yield places. So let's talk about what is really happening, with clear truth and real reasons. The first big reason is the strong US dollar. America kept interest rates high for a long time. When the US keeps interest rates high, global money flows toward the dollar. Investors choose the dollar because they get better returns and feel safer. That means currencies from emerging economies lose demand and lose value. The ringgit is one of them. This is not Malaysia's fault. It is the global money system. When the dollar rises, currencies like the ringgit, the Thai baht, the Korean won, and even the Japanese yen feel pressure. Investors move money into American bonds, into US stocks, into the US banking system. So the ringgit weakens simply because investors park their money in America. This is global power, not a local failure. Another reason is interest rate differences. Malaysia kept interest rates moderate to support businesses and prevent the economy from slowing too much. If Malaysia raised interest rates too high like the US, businesses and borrowers would suffer. Loans would get expensive. Economic growth would slow. Malaysia chose stability for its people instead of reacting to the US like some other countries did. But the market punishes that kind of kindness. When Malaysia has lower interest rates compared to America, investors say, why should we keep money in ringgit if US bonds pay more? Then they move their money away, and the ringgit drops. Another truth, Malaysia exports a lot, but the global trade environment changed. China slowed down. Europe struggled. Supply chains shifted. Electronics demand cycles are always up and down. When global trade weakens, currencies of export-dependent nations suffer. Malaysia had strong trade months recently, yes, with impressive surplus numbers, especially in critical minerals and electronics, but investors still worry about global slowdown, and those worries push the ringgit down. Even if Malaysia performs well, sentiment around emerging markets can drag currencies down because the market looks at the whole region together, not always at individual performance. There's also the simple fact that when global investors fear risk, they withdraw from emerging markets fast. Malaysia is a safe and stable place, but global investors often act like all emerging markets are one group. If they worry about global recession, or oil prices, or China-US tensions, they sell emerging market currencies, including the ringgit, even if Malaysia is doing fine. It's not fair, but it's how global markets behave. And when speculative traders see the ringgit dropping, they sometimes bet even more against it, which accelerates the fall. Another key factor is Malaysia's Economy Balancing Act. Malaysia has strong fundamentals, political stability improving, manufacturing strength, a growing role in semiconductors, massive infrastructure investment, and increasing interest from China, Japan, the Middle East, and even Western investors. But strong fundamentals don't reflect instantly in currency value. Currency reacts more to global interest rate movement, speculation, and investor emotional behavior. Fundamentals help long-term strength, but right now the ringgit moves mostly because the US Federal Reserve controls global liquidity. Some people say the ringgit weakens because Malaysia isn't growing fast enough. That's only partially true. Malaysia is actually growing better than many developed economies. But investors want huge returns quickly. They chase markets like India, they chase tech stocks in America, they chase AI companies and crypto. Malaysia is a stable story, not a hype story. Stability is good for citizens but doesn't excite traders. So capital doesn't rush in as fast as it could. And capital outflow plus slow inflow equals weaker currency. Another factor is oil and commodity prices. Malaysia once benefited strongly from oil. When oil prices fall or swing unpredictably, the ringgit feels it. Even though Malaysia has diversified, global traders still connect Malaysia to commodities. So when oil dips, ringgit dips. When palm oil struggles, ringgit feels stress. It's market psychology, not exact numbers. There is also domestic investor behavior. Many Malaysians invest overseas. Many Malaysian companies hedge in foreign currency. Many wealthy individuals move money into USD or SGD for safety. This is not wrong. It is rational financial behavior. But when locals prefer foreign currency as a store of value, demand for ringgit stays limited. So even if the economy is doing okay, the currency still weakens. At the same time, Malaysia is trying to attract long-term investors, not hot fast money. Fast money can boost currencies quickly, but also destroy them when it exits suddenly. Malaysia prefers stable long-term investment like semiconductor factories, data centers, green energy projects, and logistics hubs. These investments build lasting value but do not immediately strengthen the currency. They strengthen the real economy first. Currency strength comes later, after production and exports rise. Now let's talk about something emotional but true. People panic when currency falls. They feel fear. Fear spreads faster than facts. But panic is dangerous. The ringgit is not collapsing. It is not losing trust. It is adjusting in a world dominated by US monetary power and geopolitical uncertainty. Malaysia is not alone. Japan's yen dropped. China's yuan struggled. Thailand's baht moved down. Indonesia's rupiah faced pressure. Even strong European currencies felt weakness. The ringgit is not failing in isolation. It is moving with global conditions. However, we must speak honestly. Malaysia must keep pushing policy reforms, tech investment, talent programs, and currency management tools. The government and central bank know this. That is why Malaysia is deepening ties with the US, China, Gulf countries, Singapore, Europe, and Japan. That is why Malaysia is building semiconductor leadership, rare earth refining, hydrogen energy projects, and digital finance centers. These moves are long-term. They will strengthen the ringgit later. But global markets are impatient, and long-term strength does not stop short-term pressure. So what does this mean for ordinary people? It means imported food, tech, and travel may feel more expensive. It means businesses that rely on imports feel pressure. It means Malaysians earning in USD or SGD are happy for now, but long-term a weak currency is not good for national confidence. But it also means exporters benefit, manufacturing gains competitiveness, tourism grows, and Malaysia becomes attractive for investors looking for value markets instead of overpriced Western ones. Is the ringgit doomed? No. This is a cycle. When the US eventually cuts rates, when global fear turns to risk appetite, when manufacturing cycles rise again, when Malaysia's new investment plans materialize, the ringgit will gain strength. But right now, markets listen only to the US central bank. That's the hard truth. Currency is emotional. Currency reflects global power. Currency reflects investor mood, not only real economy. Malaysia is stable. Malaysia is safe. Malaysia is building future industries. But markets care about interest rates and fear. Malaysia chose steady growth instead of painful interest spikes. That protects people. That protects businesses. But it delays currency strength. So the ringgit feels weak in headlines, but the story underneath is a country growing quietly while global money swings violently around it. This weakness is not a sign of failure. It is a sign that the world is rearranging. It is a sign of temporary pressure, not permanent decline. Smart nations stay calm. Malaysia is staying calm. Investors who understand fundamentals will see the opportunity. Traders who only chase short-term yield will keep moving in and out. But long-term strength comes from real production, real factories, real exports, real innovation. Malaysia is building that. And the ringgit will reflect it in time. For now, temporary weakness is the cost of choosing stability, protecting citizens from high-interest debt, and investing in future industries instead of chasing quick currency wins. This is why the ringgit is losing value today. Not because Malaysia is weak, but because America is tightening the world, markets are nervous, investors chase yield and hype, and Malaysia is choosing long-term strength over short-term currency games. The ringgit will rise again when global conditions shift and Malaysia's new growth engines start firing louder. Until then, the ringgit may feel heavy, but the foundation is not broken. It is patience, not panic, that wins in cycles like this.